Exports from China rose for a second straight month in April, albeit a little more slowly. Exports for China grew 8.5% in April on the year after an unexpected jump in March after a low base in 2022. But imports sharply contracted, falling almost 8% from last year, which points to an uneven economic recovery. Overall, the country's trade surplus still edged up slightly from just over $88 billion in March to roughly $90 billion in April. Recent reports show that the dollar's share of global foreign exchange reserves has dropped to a 20-year low. Yang Liang explains what's driving the shift away from the dollar and also how the Chinese yuan is emerging as a potential alternative.
The US dollar has long been considered the world's reserve currency for international transactions. However, recent years have seen a growing trend of countries diversifying their reserve holdings and shifting away from the greenback for trade. Now, in this video, we will explore some of the reasons, the impact of the changing global economic landscape, and how emerging currencies like the Chinese yuan are gaining traction. Recently, the International Monetary Fund reported a decline in the dollar's share of global foreign exchange reserves. Quote, the dollar's share in global foreign exchange reserves fell below 59% in the final quarter of last year, extending a two-decade decline. That's according to the IMF's currency's composition of official foreign exchange reserves. You've probably seen some of the news. China recently executed a test trade for natural gas with France settled in yuan. In March, China and Brazil reached an agreement to settle trades in local currencies. And that's not just the RMB. India and Malaysia have also begun using the Indian rupee to settle certain trades. Why are countries moving away from the dollar? Experts say this trend can be attributed to two main factors: the U.S.'s disproportionate influence in global economic affairs and the increasing instability of the dollar due to shifts in monetary policy. The U.S. dollar's power as a reserve currency has ensured that the financial impacts, for example, of U.S. sanctions on Iran and Russia's financial systems, and this has spurred many nations to reconsider their reliance on the U.S. dollar and develop contingency plans. Secondly, much concerns have been raised since the U.S. Federal Reserve engaged in aggressive monetary policies following the 2008 financial crisis and the COVID-19 pandemic. The expansionary and contractionary cycles initiated by the Fed have left global governments and markets uneasy, pushing countries to search for more stable currencies to reduce risks. While the shift away from the dollar has been slow, the Chinese yuan's emergence as a viable alternative has accelerated this movement. China's stability and the country's growing role in global trade have made its currency an attractive choice for countries such as Brazil, which regards China as its main trading partner. Brazilian officials say the new arrangements will help reduce trade costs. But of course, experts say the Chinese yuan still needs time to be more widely accepted by the international community, and further financial reforms are needed. And that's something the Chinese regulators are approaching very carefully.
All that global trade is facilitated by ports, and in the U.S. it's traditionally been ports on the West Coast that have received goods from Asia. But now ports on the East and Gulf Coast are also claiming a bigger share. That shift as labor talks at West Coast ports mark a full year this week. Nearshoring of manufacturing and fewer imports from China are factors. Container volumes on the West Coast are down 10% in the first quarter of the year compared to 2019. But Gulf ports saw a 43% jump in goods. For more on the freight slowdown, let's bring in Yan Liang, professor of economics at Williamette University. Welcome back to the show. The shifting of ports and shipment, having been in Portland and Seattle, you know how important the trade with China is to the West Coast. Los Angeles, Seattle, arguably San Francisco, and I'll even throw in there Vancouver, BC, have always been the destinations. How are they getting to the other side of the port? Because the criticism was that it was hard to get to the south and also hard to get to the east, and it's a heck of a lot further.
Right. Good to talk to you, Phil. So I think, one of the major reasons are, some of the labor disputes on the west side, on the west ports. So I think that's one of the reasons where we see some of the shifts. But that said, I think, in general, with the, inventory that the companies are trying to destocking and with the slowdown in, global and the U.S. manufacturing, and also the slowdown in consumer demand for, manufacture and other kinds of goods, we are seeing the ocean freight overall has been going down this year. And that also, brought the slowdown in other sectors like transportation, like railroad, like trucking industries. And so there has been a phrase that's been, floating, the so-called freight recession, which is basically these sectors are seeing really significant slowdown this year.
We talked about the trade numbers earlier, and there's always been this sort of difficult relationship between China and the U.S. And I've always said that, look, despite how difficult things are, China continues to buy a lot of stuff from the U.S. and vice versa. Has that trend changed at all in the last quarter? Are we seeing a dip perhaps in demand on either side?
Right. So as we all understand, the United States is now facing really severe problems, because of the fact very aggressive interest rate hikes for, 10 times. That is likely to engineer an economic recession. And now we're also facing with this debt ceiling debacle. So all of these seem to point at, the slowdown in consumer spending. Now, consumer spending is still strong in, travel, entertainment, restaurants, and other related services. But the spending on, the discretionary items has been, sluggish. So I think that fits into this problem of, demand for not just domestic manufacturing goods, but also imports from China. Now, previously, yes, there has been a lot of exports from China to the United States, partly because, again, the inventory build up, and partly because anticipating, higher inflation, some of these retailers are stocking up. So it remains to be seen how much, right, the U.S. economic slowdown is going to be, and then how the price competitiveness of the Chinese exports can still maintain certain shares in the U.S. market.
But we look at the trade deficit. I mean, the U.S. is still spending significantly more on China than the other way around, right? So, you could argue that's healthy or not healthy, but the point being is that that really hasn't changed over a very long time. It's always been like that. Is there some concern that that might ultimately finally shift to, say equilibrium?
Well, I think, one thing that it's clear is that, despite all this political rhetoric about decoupling, the two economies, the U.S. and China, remain really deeply entangled. So it's very difficult, for companies from the United States simply to source supplies elsewhere, even though there are signs that in some sectors, in some industries, we do see some sort of shift of, U.S. Sort of sourcing supplies from China to, countries like Vietnam, Cambodia, and elsewhere. But that said, again, because China occupies such an important node in the global supply chain, it's very difficult for the U.S. To find other really competitive and alternative suppliers. Now, that said, again, I think the bigger problem is the U.S. economic slowdown, and so that could, in general, right, reduce the demand. But if the demand is there, I think then companies will continue to source.
It's like
from China.
Professor, I view it as a married couple who just fight all the time, but then they have to go back and I guess make things work. And we're kind of the children and the public, because you're right. I mean, the two sides clearly need each other for the time being. And all this talk about decoupling to me is silly, because it would take 50 years or 100 years, and it still may not be possible at that point. One of the chief issues that we've faced is the retailers and shippers who are planning, which they're right now making orders for probably Christmas, I'm guessing, for fall and Christmas orders. Have you heard from your sources as to what the order numbers look like and what the demand looks like for this coming fall and winter?
Right. So I think it is a very difficult time for all of these retailers to plan ahead, right? So on the one hand, we're not sure how the inflation is going to be, how sticky it's going to be. So if you anticipate high inflation, you want to stock up now. But then at the same time, it's hard to know where the U.S. economy is heading towards. And so that then would make you think twice in terms of, how to plan for your shipment. So I don't exactly know how business is working on now, but I think the early signs is, again, the global manufacturing PMI has been slowing slowing down. And also a lot of the companies are dealing with their inventory issues. So if you want me to make a guess, I would say, they probably be very cautious in terms of, hiking up their inventory for the holiday seasons.
Right, which I suppose might be positive if you're worried about inflation because there's the demand issue, but I guess we shall see and we don't know. Professor, good to see you. Thank you.
Thank you, Phil.